Tyler, we've already done one video with a couple of stocks that you brought to the show, a couple of high yield dividend stocks. One you think is a buy right now, one you think investors should be avoiding. How about a couple stocks that I got we can talk about?
Let's play a little role reversal here. I get to play host. I mean, I'm still going to make you do the read in, but let's do this. I'm going to actually ask you questions this time.
Love it. Fair enough. I'm Jason Hall. He is Tyler Crow. This is Investing Unscripted. This video is sponsored by The Motley Fool. We've got two great stock conversations we're going to have right now. But if you want even more great stock ideas, you should go to our special link. It's fool.com/unscripted. Go to that link. The Motley Fool is going to give you its 10 best stocks to buy right now. Definitely check that out. Okay, Tyler, handing it over to you.
All right. So I get to be the host this time. I get to probe you with all the questions that I want. But in our previous iteration of this video, I brought together Nextera Energy Partners. I said, this is probably not something you want to get involved in, but maybe look at Brookfield Renewable instead. So, same premise. If you're looking for something in the market that maybe a lot of people are looking at, but you're like, I don't see it. And what is that for you right now?
So Tyler, we've done videos about this one before, but there is a high yield dividend stock that's been paying a dividend for more than a half a century and growing that dividend every year, even though if we're being honest, the growth rates have been paltry more recently. And it's getting a lot of attention from investors. And that's 3M. The dividend yield is knocking on 6.5% right now. It is substantially higher over the past few years than it has been over the long term. We've made a video about it before, and we've highlighted some of the reasons why we think investors should give pause to investing in 3M right now. I'm going to break it down. So, as a starting point, the company's facing a lot of lawsuits, and there's two primary issues. Now, the good news with one of them is with its combat arms earplugs. The lawsuit was filed because of hearing damage to U.S. military personnel. And the good news, it looks like they have a settlement on that. So they're going to be moving forward from that. Could be up to $6 billion cost to do that. Now, there's also some other good news with their other one, with their PFAS, the so-called forever chemicals, $10.3 billion commitment over a 13-year period. So right there, you've got close to $17 billion in obligations towards those two lawsuits. The forever chemicals issues are not over, right? So I think that's an important thing to remember is that there's going to be continued pressure as we move forward with potential legal risk for 3M. Now, Tyler, there's another thing that we've talked about with 3M too that, well, it's not just the issues with the ongoing litigation and legal costs, but the reality is that 3M has lost its edge. This is a company that hasn't been a leading innovator, hasn't disrupted markets, and hasn't really delivered above average growth for a very long time. We've seen its margins have shrank, operating costs have gone up, and that's squeezed its bottom line over the long term. As a result, I want to share this number because I think this is maybe the most important number that people should be thinking about when you're thinking about dividends, and that's net income and payout ratio. So the company's net income, again, as you see, is not growing, and it hasn't grown for a long time. Massive loss, again, this is related to the settlements for some of the lawsuits that we've seen. And there's going to be even more that are going to show up on the books in 2024. But as a result, its payout ratio, typically been around 50%, has actually gone negative, right? The reality is a negative payout ratio is really bad because it means you're actually losing money. So again, the key point here is there's a lot of pressure on the company's bottom line right now. And it feels like management has been so focused on maintaining that dividend streak and staying on that list of dividend growth companies, dividend kings and others, is that they've lost focus on what really matters. And that's innovation in the business, creating products that create value and then apply that to the scale of a 3M to create growth in your operating cash flows. The company hasn't delivered on that. So I think that as compelling as it may look with that high yield right now and investors that look backwards and say, wow, they've paid this out and grown it for a half a century plus. The reality is if you're an income investor, I think you're taking on a little bit of onerous risk to buy 3M in its present state, expecting that the dividend is just going to continue. I think you could look at Walgreens Boots Alliance. Tyler is an example of a high yield dividend stock, a dividend stalwart that paid and grew the dividend for decades and decades that eventually, well, the growth story ended, faced some problems, and ended up cutting the dividend. They had to cut their dividend almost in half just a couple of quarters ago. So I think there's some substantial risk for 3M investors that are looking for income.
I think a lot of people are looking at the recent spinoff of Solventum, which was their kind of healthcare unit business, as like a salve to some of the ails that it has had. But this is a business you and I have talked about for like 6, 7 years. It feels like we've been listening to conference calls or reading about in their earnings trends about restructurings and trying to like cut costs versus, innovation and delivering new products to the market, which is, kind of like we said, it's been 3M's hay for a really long time. So it'll be interesting to see whether or not the kind of the spinoff of Solventum provides investors with some value accretive sort of investment, whereas kind of maybe the commodity businesses that is left at 3M and the burdens of the lawsuits that we've been talking about can be kind of shouldered by this other entity. But, that's the bad news. We've talked about it a bit. So if 3M is not the stock that you want to be involved with right now in terms of high yield, where do you want to go?
So I wanted to stick with a similar theme, and that's the theme of going through a bit of a turnaround and some perceived risk. But in this case, I want to talk about a company that I think the perceived risk is actually larger than the reality, unlike with 3M, where I think investors are saying kind of downplaying the risk. And that's EPR Properties. So people that don't know EPR Properties, this is a real estate investment trust and it's experiential real estate. So good news, that's a really big market. It's a $100 billion addressable market, lots of different places and things that it fits into. Eat and play is a really big part of it. Experiential lodging. They actually, I think a lot of people don't know, they own some ski resorts. Fitness is a growing part of their business. They own some Six Flags. They own the real estate. And then they own the real estate, but then they partner with really good operators that are their tenants, right? Now, of course, a struggling part of this business this is the risk, is movie theaters. This is its largest in terms of base rents, 37%. Now, Tyler, this was over 40% a couple of years ago. So they've already been executing on their strategy to reduce exposure to that. They've grown Eat and Play substantially. Fitness and wellness is one that they've started to grow and expand. And you put that together, and what I see is we went through this moment with the movie theater industry where it was kind of an existential crisis during and immediately after the coronavirus pandemic. It was a scary period. We've seen one of its largest tenants go through bankruptcy. Here's the thing. It didn't really affect EPR Properties. It came out and its rents were essentially the same as they were going into it. We've seen AMC theaters in North America face a tremendous amount of pressure. The AMC theaters that are owned by EPR are some of their most valuable, best attended, and most important locations. What that means is that even if we saw an AMC go into bankruptcy, there is a high probability that those particular locations would be some of its most important. The outcome would likely be minimal in terms of potential harm to EPR Properties.
We kind of already have a blueprint for the failing theater aspect, Regal Cinemas, which did
Right.
fall into
Right.
bankruptcy restructuring. And the key here is when we hear the term bankruptcy, it doesn't mean these companies disappear. It's a corporate restructuring where they, reevaluate debt, they reevaluate leases. These businesses just don't go away. They continue to operate in some form and they still continue to typically
Right.
pay rent. Sometimes
Mhm.
the leases are renegotiated at slightly lower rates, but it's not an absolute zero as like I think a lot of people think of when they hear the word bankruptcy.
Yeah, no, that's exactly right, because it's not a situation where they just lock the doors and everybody goes home and the last person turns out the lights. They have to continue operating, right? If they want to emerge, and they have to maintain relationships with their key suppliers and vendors. And well, if you're a theater operator, you know who one of your most important suppliers is? Your landlord that owns the theater, right? So again, I think you're right. And we're starting to see some recovery. Box office revenues have started to bounce back. Are they ever going to return to these levels? We don't know. But again, the difference is the level of health we're at, right? So that perception, I think there's opportunity here besides that, because it always comes down to risk and reward. Are you taking on some risk? Certainly. But is the potential reward for that risk make it worth it? And I think in the case of EPR, it certainly does. Its dividend yield over the past 10 years, the average yield is just under 7%. Now, of course, part of that was when the stock price crashed during the pandemic and the yield skyrocketed. Then, of course, they slashed their payout, which they've steadily recovered that payout. So if you think about the yield that you're getting, it's about a 15% higher yield. So that puts it in, to me, puts it into value territory. So I think investors that are looking for guaranteed income, is there some risk? Sure. But if you could afford a little bit of a haircut if they needed to lower the dividend for a period of time, if there was a protracted bankruptcy and it did up in some of their rents payments on a portion of their portfolio there before they could reduce exposure to it, I think it's still absolutely worth buying right now.